an interest in natural resources? I suspect because in my teens I liked to be out of doors. My stepfather was a biologist. Both my mother's family and my father's family were in some way, shape, or form involved in natural resources, oil and gas, and agriculture. It's ironic that a love of outdoors caused me to pursue a life's work which has kept me cooped up in an office for 50 years. The irony of that is not lost on me. If the Fed suggests that a quarter basis point is the beginning, that they are prepared to, quote, do whatever it takes, then I think investors know around the world that U.S. society has no interest in defending the integrity of the U.S. dollar.
I think what you mean is you wish it wasn't the case that the U.S. dollar would decline its purchasing power by 75%, right?
Steve, I don't own gold to make money. I own gold to maintain my purchasing power. Think of it as insurance.
Yeah.
If you think about insurance as an investment class, it's one that you don't want to get paid off on. Life insurance means somebody died.
Yeah.
Auto insurance means you had a wreck. Home insurance means you had a fire. The whole set of circumstances that makes all of those decisions pay off is bad. And I would love to be wrong.
Good day. Hello, everybody. This is Steve Yang. Today, I'm honored to be joined by a true legend in natural resource investing, Rick Rule. Decades in the business, mining, metals, macro. If you're in the space, you already know Rick's insights are must hear. And I know many of you have learned a lot from his boot camps in the Rule classroom, which we'll get into later. Someone said to me recently that Rick's doing God's work. So, Rick, thank you for being here.
Well, it's a pleasure. I'm delighted to be here with you, and I'm delighted to still be in front of the audience after all these years.
Rick, you're too humble. Rick, you've been around for a while. You've seen the ups and downs in the industry. You lived through multiple cycles. Curious, first of all, what pulled you into the industry and what keeps you so engaged today?
I don't know exactly why I developed an interest in natural resources. I suspect because in my teens, I liked to be out of doors. My stepfather was a biologist. Both my mother's family and my father's family were in some way, shape, or form involved in natural resources, oil and gas, and agriculture. It's ironic that a love of outdoors caused me to pursue a life's work which has kept me cooped up in an office for 50 years. The irony of that is not lost on me. But the truth is that the business is endlessly fascinating. And compared to other businesses like technology, fairly simple. It is also a business where once you learn the ground rules being that it's capital intensive and cyclical, therefore it's contrarian, that although you can get some things wrong with regards to timing, if you get a few things right, you're almost certain to make money. And I like that. I'm not the guy who always buys at the bottom and sells at the top. By the way, Bernard Baruch said that person doesn't exist. He or she was a liar. But the cyclicality of resources has meant that it's been possible for me to take a big fat chunk out of the middle in most markets, which is all I ask for.
Cyclical and contrarian. Love to learn more about how those things go together and learn from you here. Hope the audience can learn as well. We've had a metal sell-off. We'd love to know what's going on. Some say it's overdue. We had some movement today as well, but what do you see as the main trigger for behind the pullback, first of all?
I think it got ahead of itself. If the metals that we're talking about are gold and silver, you need to decide
Precious
as an
metals.
example in the gold market where in a little over 12 months it's doubled and then it sold off 6 or 7%. Is it down 6 or is it up 94? It's your perspective. If all of my markets were this treacherous, which is to say they give me 100% profits and then they take back 6, I would be a happy guy. It's interesting the way people look at these things too. They purport to be bullish on gold in the long term, and then they treat a sell-off like something other than a sale. If you believe in the commodity, and the price of it comes off, you should
Yeah.
be happy. It's odd the way people view things. When most people shop for consumer goods, they're reasonably rational. When people shop for financial goods, it seems that they need upward momentum in price to justify a narrative. But the
Hmm.
upward momentum in price devalues a bunch of the narrative. It's
Yeah.
wild that there was no action at all in retail gold windows at $2,000 gold and barn burner action at $5,000 gold. If people would pay some attention to a narrative before it proved out in the market, their financial performance would do much better. In answering to the question, I think that the metals prices retreated simply because they went too far too fast. They needed they needed a pause, and there were some hyper aggressive speculators who, when some I don't know technical parameter got violated, decided to sell. They probably didn't know that much about the metals, and they might not even know that much about markets. But their faith was shaken very, very, very easily. Steve, I'm answering this question for too long a time, but I remember very well in the decade of the 70s, a market that saw gold go from $35 an ounce to $850 an ounce, a 30-fold move, truly an epic move.
Yeah.
In the middle of that bull market in 1975, the gold price was up sixfold. It had a hell of a move. And there was a whole bunch of people as a consequence of the move from 35 to 200 that were, let's just say, born again gold bugs, right? They got the gold religion. And then in 1975, the gold price fell from 200 to 100. Now, if these guys were religious adherents, why weren't they happy with the price decline so that they could buy more? But the narrative that was true at 200 didn't seem to be true at 100 anymore. And a lot of people got shook out. I knew them, or some of them. And they missed a move in the market from $100 an ounce to $850 an ounce. It happened in 5 short years. So I think it's important that people understand what they want out of an investment, gold or anything else. And they think about how they will respond financially and psychologically to both volatility and cyclicality, different things. And that they prepare
Yeah.
themselves to act accordingly. They won't do that, of course. Most people still stick to the dictum, got a
Yeah.
hunch, bet a bunch. But those people are beyond help, either for you or for me.
Are you for the short term? I know I think I hear you saying that you're a gold bug for the long term. But for the short term, are you expecting a V-shaped rebound? Should investors be prepared more for a downside in the immediacy? And how do you feel about redeploying capital at this time?
That's a narrative question. I think it depends on the tone of the Fed tomorrow. If the Fed suggests that a quarter basis point is the beginning, that they
Yeah.
are prepared to, quote, do whatever it takes, then I think investors know around the world that U.S. society has no interest in defending the integrity of the U.S. dollar. And then it's game on. If they're moderately hawkish tomorrow, then gold has some more to fall, I think. I mean, to me, I think you've got
Yeah.
my tone. It's absolutely irrelevant. I expect over 10 years the gold price, in nominal terms at least, to do extremely well. And what it does over the next 3 months is, to me, interesting but not relevant.
I'd love to go back to the Fed conversation. You were telling me about Warren Buffett and his philosophy on things, but if you can uh, tell me your thoughts on what's going to happen tomorrow. Their meeting. What are you expecting? Are you expecting rate cuts for them to be aggressive? Policy pivots? Are
They've,
you? Yeah.
I mean, they've signaled pretty broadly, and they're under incredible political pressure to cut the rates. I know that the institutional bias of the Fed, because I know a reasonable number of lower level Fed employees, and by the way, a
Yeah.
couple Fed governors. Uh, the institutional bias is to keep interest rates stable or raise them. The Fed
Yeah.
believes itself to be the only institution in government that cares about the sanctity of the US dollar. They know that neither Congress nor the president has any interest in reining in spending.
Yeah.
And I mean, at the lower levels in the Fed, they absolutely positively believe that they are the only arm of the US government that stands between the dollar and the abyss. That notwithstanding, the top of the Fed is pretty political, despite protestations to the contrary. So it's likely that there will be a rate cut tomorrow. What I think the market is looking for signals on is the discussion around the rate cut, um, the rationale for the rate cut. When you listen, at least to Republican politicians, we're enjoying a pretty good economy. If we're enjoying a good economy, why would you cut the rates? Bond market is strong. Why cut rates? Equity markets are strong. Why cut
Hmm.
rates? It will be interesting to hear them justify cutting rates when there's no feasible reason to do so. By the way, I'm not singling out the Republicans for criticism. Were the Democrats in office, they would be asking for the same thing. And I really think it's going to be in the tone. I think the second thing that's going to happen is if they cut rates, and if the rates, as they should be, are reflected in other yields, I mean, the near-term impact of a rate cut is that you increase the value of the capitalized distributions of all existing bonds. It would, in the near term, be very good for the bond market. But if you see a rate cut where that rate cut
Hmm.
doesn't impact the long bond yield,
Hmm.
in other words, where the market reasserts control over the long bond yield rather than the Fed, which is
Yeah.
in the last 6 months, you will have an interesting phenomenon. And if, as a consequence of lower 10 and 30-year yields, the next Treasury auction isn't successful, which is to say, if the Fed has to buy their own paper, then the gold game is on in earnest. Notice I said if, I didn't say when, I said if. But it's interesting what you're seeing in the market. The lower end of the yield, the Fed, with the assistance of Tether, can maintain. Tether and various money market funds are hoovering up all the sub 2 year paper that they can. And because there's a bid for it, the Fed is
Hmm.
issuing a lot of it. Uh, the longer term yields, the 10-year terms, the 20-year terms, the 30-year terms, have become
Hmm.
disconnected to the near term, which suggests to me that the market, the bond vigilantes, are reasserting control over the long end of the yield curve and beginning to pay some attention to
Hmm.
inflation. So it's an interesting thing. I myself remember when, in effect, the Fed lost control of the
Yeah.
markets, and I remember a very brief time in the Clinton administration when the Fed lost control of the interest rates again. Clinton talked about if he died, he wanted to come back as the bond market because the bond vigilantes had the real power in the economy. Now that was in the 1990s, but I suspect it could happen again.
So, what are you anticipating it does to the metals and mining market and immediacy?
I have no idea, none. You're asking a popular culture question, and as
Yeah.
you can tell, I can't even dress myself. The idea that I would understand the impact of theater, which it is, on the market is just not something I'm qualified to do. I think there's still a lot of
Yeah.
ambition in the market. I think while I would argue that our society at the federal level is insolvent, we're not illiquid. There's a lot of cash on the sidelines, a lot of cash on the sidelines. And that cash doesn't like getting paid 4%. That cash would like a higher yield. So I think the market would like to use any excuse it had to go higher.
So, I mean, how much concern are you sensing from the people you talk to? I mean, are you seeing concern? I mean, I know you've come from the banking industry. You've been in the banking world for a long time. I mean, what are you seeing with the banks? Is there a real strain there? Is there tighter credit, cautious lenders? I mean, how concerned are you about the market
The
industry?
banking community, with the exception of some old pros like myself, would love to see lower interest rates. The banks are concerned about non-investment grade credit, so-called junk credit.
Yeah.
The banks are really concerned about commercial real estate lending concentrations on their own portfolios. They would love to see these borrowers be able to refinance, particularly somewhere else.
Hmm.
Um, they are also, in terms of the biggest banks, very concerned about the fact that although they shouldn't have been, they've been spread lenders. They have lent long, lent for 7 or 8 or 9 year terms at fixed rates and funded that lending in the overnight market.
Hmm.
Rising interest rates kill you if you're a time spread lender. The capitalized value of your long-term bond yields falls at the same time that your cost of funding it increases. That's
Hmm.
what busted the savings and loan industry. And it's busted Silicon Valley Bank. So
Yeah.
the bias of bankers, particularly bankers that have some mistakes on the books, which is almost all legacy bankers, is for lower interest rates.
So if you were to be a betting person, you'd what? Guess what? Half a point,
Quarter point.
quarter point.
Yeah, I think the bias within the Fed is not to lower it at all, but the Fed, despite their alleged independence, doesn't have much say in the matter.
So do you anticipate, first of all, the what do you think the lower interest rate does for the U.S. economy? I mean, it's been slowing down. Do you continuing to see that till end of Q4 or Q1?
I think it's probably good for confidence. I think the underlying problems with the economy are structural, though.
Okay.
We have a bunch of people in our economy that don't have the skill sets or the education to compete globally. A quarter point rate cut
Hmm.
doesn't help a 60-year-old auto worker making $50 an hour who is trying to compete with a 23-year-old auto worker in India or China
Hmm.
making $5 an hour.
Gotcha.
It doesn't make a difference there.
Okay.
And I think that's important. Working Americans, not all working Americans, but I would say 80 million working Americans don't have the skill sets
Hmm.
that are necessary for them to earn a living wage in this economy. I think the minimum wage is what? Something under $8 an hour.
Hmm.
The functional minimum wage in the community that I live in Northwestern Washington, is about $20 an hour,
Hmm.
almost 3 times the minimum wage. And $20 an hour isn't a living wage in my community. And a 25-point rate cut isn't going to address that at all. So the structural problems in the economy aren't
Hmm.
going to be addressed by a rate cut. Strains in the banking business, those will be introduced, those will be impacted by a rate cut. Making mortgage banking as opposed to mortgages more
Hmm.
affordable? Absolutely.
Yeah.
If lenders are paying deposit interest rates that fall on commitment, which is to say a quarter point, likely won't pass that quarter point on to consumers of 30-year credit, but
Hmm.
they will use lower cost deposits to finance the generation and warehousing of mortgages, which they subsequently rehold. The lower interest rates are a huge subsidy, a huge boon to the bank. One way, Steve, that I think you could subdivide society is you could subdivide by spenders and savers.
Hmm.
Lower interest rates are very good for spenders and they're very sad for savers. And in a democracy, spenders are much more numerous than savers.
Yeah.
So the spenders will always vote to steal money from the savers. That's the way it
Yeah.
works. And I think that's what you're seeing writ large in the Fed's decision.
That's the downside of fiat, right?
That's a
And
downside of fiat.
but,
Yes. That's a downside of fiat.
uh,
Yes.
so or one of many. So you talked a bit about the person in India $5, whereas in the United States it's a lot more. Do you see that as a downside of the reserve being the reserve currency of the world, and just kind of how that affects the price of things?
I mean, not if you're an American consumer. It's not a good thing if you're an American auto worker.
Yeah,
If you're an American consumer, you would be benefited if Toyota could sell a Hilux pickup truck in the United States.
yeah,
A pickup half again as good as most American pickups at half the price. It would be good if we could buy BYDs in the United States as opposed merely to Teslas.
yeah,
That circumstance is not good for auto workers, but it's great for consumers. The
yeah.
globalization that we saw in the world post, say, 1990 was a huge boon for U.S.
Hmm.
consumers. It was not so good
Hmm.
for semi-skilled workers who were displaced. So I think it really depends on your perspective. I believe in
Yeah.
completely free trade, not managed trade.
Hmm.
I believe that an economy is stronger if they play to their advantages as opposed to subsidize their weaknesses. But
Yeah.
I realize I've been lucky in life. I managed to acquire the skill sets and the knowledge to apply those skill sets that set me apart from most folks.
So what's the solution here for you said the rate cut's not going to help. Structural economy is the structural is the issue here. So is there anything in the immediacy that might effectively change things, or do you see this as essentially
I
the
think,
end of the dollar sort of thing?
no, I mean, I think what saves the U.S. economy ultimately
Yeah.
is technology
Okay.
and the American private rather than public culture. You may
Tell
not
me
remember,
more.
we talked about this the last time you interviewed me. The United States is still, for all its faults,
Yeah.
perhaps the most dynamic culture on the planet.
Hmm.
It's a place where 4 or 5 young kids take over a garage in Sunnyvale and out pops Google or out pops Apple,
Yeah.
at once creating several $100 billion worth of wealth, but much more importantly, lowering structurally the cost of doing business, enabling business to get more done with less capital.
Hmm.
Uh, I noticed the other day that Amazon is preparing to lay off 30,000 people.
Hmm.
That'll be a very hard thing for the 30,000 people. They aren't laying them off because they're hard-hearted. They're doing it
Hmm.
because their output at $18 an hour uh, doesn't compete with the output generated either by artificial intelligence or by a robot. This is good for the economy.
Hmm.
The fact that you can enable the output of more goods and services for less capital expense and less operating expense is good for the economy.
Right.
It is not good for 30,000 workers, nor to the businesses that service them.
Hmm.
Um, I think it's inevitable. I mean, I think the U.S. has a reckoning to face. We have deep, deep, deep structural issues that aren't addressed either by a rate cut or by politics.
Yeah.
We owe more than we have. We are spending beyond our means. We went through this in the decade of the 70s. We reduced the purchasing
Hmm.
power of the US dollar by 75%, which meant that we lowered the nominal value of our obligations. And then we
Hmm.
didn't reduce the size of government, but we slowed the government's growth for 12 years. When we went
Hmm.
into the interest rate cut cycle in the early part of the 1980s, uh, the economy sped up to the extent that we could, in effect, amortize our debt.
Hmm.
And I think that's probably what happens again. I think we reduce the purchasing power of the US dollar by 75%. We slow the growth of government. And ultimately, that's probably enough to get us through. But there's a 10-year reckoning until it does.
Wow. What does that do for the gold price?
In if past is prologue, in the decade of the 70s, when the purchasing power of the US dollar declined by 75%, by the way, that's not my number. That's the Office of Management and Budget. That's the government's number. the gold price went up 30-fold. Now, I'm not
Yeah.
suggesting to you that the gold price goes up 30-fold from here. It's already gone up 12-fold since the year 2000.
Yeah.
But it wouldn't surprise me at all if the gold price in nominal terms, which is to say US dollar terms, didn't increase to reflect the decline in the purchasing power of the US dollar. There's an arithmetic symmetry there that makes sense to me. If that's true, not the real price, but the nominal US dollar price of gold could be expected to increase threefold or even fourfold over 10 years.
Wow.
I wish it weren't true. I would love to be wrong about my gold holdings.
For a gold bug, I don't. It's hard to believe that statement. I think
Well,
what you mean is you weren't. You wish it wasn't the case that the U.S. dollar would decline its purchasing power by 75%, right?
Steve, I don't own gold to make money. I own gold to maintain my purchasing power. Think of it as insurance.
Yeah.
If you think about insurance as an investment class,
Hmm.
it's one that you don't want to get paid off on. Life insurance means somebody died.
Yeah.
Auto insurance means you had a wreck. Home insurance means you had a fire. The whole set of circumstances that makes all of those decisions pay off is bad. And
Yeah.
I would love to be wrong on my gold portfolio because the rest of my portfolio, particularly things like forest land, farmland, oil and gas, copper,
Hmm.
all those things would do spectacularly well if the economy did well. So on balance, I'd love to be wrong with regards to my gold, but I don't feel like not having the insurance that gold offers me.
So you see gold primarily and silver as primarily insurance,
For
and you
me,
see the opportunity. Yeah, for
I'd
you.
cut the sector in three boxes.
Okay.
Insurance, which is physical metal, and gold, by the way, not silver for me.
Okay. Gold only.
As an investment, I see very, very, very high quality mining shares. The high quality companies over the
Hmm.
cycle seem to perform about twice as well as the metal,
Hmm.
but you take operational and financial risk. So it's an investment operation. Then the sector that I've traditionally focused on has been the smaller cap companies, the juniors, as it were. Those aren't investments, they're speculations.
Hmm.
So I look at the sector as insurance, investment, and speculation. I'm active in all three categories,
Hmm.
but I'm old enough not to confuse them.
Gotcha. Like, do you see there being a big opportunity with the majors at all, or
I
do you
do.
just primarily see that
I
as
do.
you do?
No, I absolutely do. If past is prologue, uh, over the course of 10 years, if the gold price goes up threefold,
Hmm.
the major should go up five or sixfold for the simple reason that increases in the gold price increase the operating margins faster
Hmm.
than the increase
Yeah.
in the gold price. And the companies that don't screw that up operationally
Hmm.
could be expected to benefit. A cautionary note in the decade 2000 to 2010, the gold price went up
Hmm.
sevenfold. And the gold mining companies were so poorly run that free cash flow per share fell. It took real skill to screw up a sevenfold increase in the selling price of your product and have lower free cash flow per share at the end of the decade than you had at the beginning. So there are risks, which is why it's an investment activity as opposed to an insurance activity. But I think that investors and managers learned a lesson, and I would expect financial prudence will continue in the gold mining industry for at least 2 or 3 more years.
So, do you see physical gold as insurance, or do you also see gold stocks as
Physical
you
gold,
physical gold, and you see
physical gold. Yep,
gold companies as an investment opportunity,
yep.
and you divide it into three different hats,
Three, three buckets. That's
three
right.
buckets. And which of those do you see as the greatest opportunity that balances not only upside and torque, but also,
Depends
like
on
how do
how
you?
hard the investor is willing to work. Investors who aren't willing to really work should not speculate.
Okay.
I believe that there is enough beta in the gold market. I define beta as the extent to which the sector outperforms the broad market. That
Hmm.
a reasonable approach for an investor who was looking to maximize his or her gain without taking inordinate risk or doing inordinate work, that person's portfolio might consist of Agnico Eagle, Franco Nevada, and Wheaton Precious,
Mm-hmm.
uh, the best of the best.
Yeah.
They might drop down to the best of the rest. You know, the Newmonts is an example. But really, most investors don't need to go beyond that at all. And if you go beyond that, understand that you might be right about the sector, gold, and wrong about the company,
Right.
and expose yourself to operational failure and miss out on the beta searching for alpha. If you
Mm-hmm.
believe, as I do, that it is not unlikely that over the next 10 years, the best of the best in terms of beta investments go fivefold or sixfold, it becomes a function of how greedy are you, how much risk are you willing to endure, and in particular, how much work are you willing
Yeah.
to do? Because speculation is hard work.
Yeah.
Uh, Steve, you know I've graded tens of thousands, perhaps 100,000 natural resource portfolios for free for 35 years. I've learned a lot about the way people invest and speculate. And one
Yeah.
of the great faults for investors, other than being counter contrarian, which is to say, investing in rich markets and not in poor markets, the other mistake that people make is they own too many stocks relative to the amount of time that they spend studying their investments. It's very common for me to grade a portfolio that will be a laundry list of 60 or 70 stocks. I ask people to own the number of speculative stocks that corresponds with the number of hours per month they're willing to work studying their stocks. And I find
Mm-hmm.
that almost the inverse is true. There are some people who believe that they limit their risk through diversity, but they own 50 or 60 names they know nothing about, which is
Mm-hmm.
to say that they have 50 or 60 headings under the category ignorance. And that's not a recipe for success. So, by all means, speculate. All of the money that I now invest carefully, I
Mm-hmm.
earned through speculation.
Yeah.
But I worked hard, I was disciplined, and I got lucky.
Yeah.
And people who seek to emulate the success that I enjoyed will
Mm-hmm.
have to emulate the work that I put into it. And it's not easy. For people who have lives,
Yeah.
they might consider Agnico, Franco, Wheaton, stop.
Mm-hmm. So when you look at someone's portfolio and when you grade it, when you assess whether or not they're doing it out of ignorance, like what do you ask? Like, do you know XYZ? Like,
Well,
what
often
are
I
the
talk
main things that you need to know?
when I ran a brokerage firm,
Yeah.
and I would use these portfolios in effect as lead lists.
Yeah.
I'd talk to these people sometimes, and I'd say,
Yeah.
"Okay, let's go through your portfolio. Okay, we're in the A's, amalgamated aardvark." And they say, "Yeah, I wanted to ask you about that. What do you think of amalgamated aardvark?" And I'd
Yeah.
had to say, "Well, I was blissfully unaware of its existence until now, but that doesn't matter. I don't own it. What do you think about amalgamated aardvark?"
Yeah.
"Well, I don't know anything about it." "Well, if you don't know anything about it, why do you own it?" "Oh, well, I own it because Bob Bishop recommended it to me."
Mm-hmm.
Bob Bishop's been retired for 15 years. And then they say, "Well, I can't sell it. Why can't you sell it?" "Well, I bought it for $4 and it's at 40 cents now. If I sell it at 40 cents, I'll lose $3.60. And then I have to say, now I get it. You've already lost the $3.60. The question is, what are you going to do with the remaining 40 cents? If you think
Yeah.
it's worth more than 40 cents, you should buy more.
Mm-hmm.
If you think it's worth less than 40 cents, you should sell it.
Mm-hmm.
Don't have any opinion. Why do you have a position?" It's that process, that sort of iterative process
Mm-hmm.
that lies at the heart of speculation.
So for these companies, for these juniors that have, greater speculation, I know that you and I talked briefly about, mentioning company names in an interview and how things can change so quickly. So when people listen to a Rick Rule interview and they hear a company and they buy it, based off of what Rick Rule says. Does that drive you crazy? Is that
It's
flattering? Is that
it's stupid. It's absolutely insane. First of all, the set of circumstances that caused me to buy it could change tomorrow. And unless that person knows what I think tomorrow, and I might not be willing to tell them, they don't know enough to own it. Uh, you you can use my suggestion
Mhm.
as a way to look at subjects that you then study for yourself and develop your own conclusions about. I think I'm pretty good at that. But
Mhm.
buying it simply because I said
Yeah.
so, and then not paying any
Yeah.
attention to the reasons that I bought it is counterproductive. A lot of interviewers want me to name names because then they can get a flashy headline for their interview and get more views. Rick Rule talks 10 stocks, right? Some kind of hokum like that.
Mhm.
Uh, but having a name without having an opinion or without
Mhm.
having knowledge is a real recipe for failure.
Yeah.
I've spent hundreds of hours on instructional programming at the Rule Classroom, and the
Mhm.
Rule Classroom is much more valuable to investors than any individual name I might give them. Once they've familiarized themselves with how to develop their own opinion,
Mhm.
once they've paid attention to our syllabus in terms of things you should read to learn more, then the names become valuable because they become, in effect, a lead list. But until then, they're just entertainment.
So let's talk about that. You got boot camps, you got the classroom. If you can tell me the difference, and it seems as though you are more concerned about teaching people how to fish than to give them fish. If you
Correct.
can
Yeah.
kind of talk
I
about the
mean,
value you guys give.
the value proposition is very much a work in progress, which is to say, I started Rule Investment Media and the Rule Classroom as teaching tools without any sense of how I might monetize them, figuring that if I built a coterie of investors who I had served,
Mhm.
I'd find a way to make money on it later. And if I didn't, that's okay. I'm old, fat, rich. I've already made money. Uh, but I like to build businesses, so a
Yeah.
business has to be self-sustaining.
Yeah.
So it goes like this. Rule Investment Media uh, ranks portfolios. You send your portfolio in, I rank it.
Mhm.
And from time to time, I send you communications that I find interesting. There's no advertisements in those communications yet, except
Mhm.
for advertisements for my own value added products, the
Yeah.
boot camps and the conference. By now, those boot camps and the conference are very good businesses. And the
Mhm.
fact that my own database, the Rule Investment Media database, is far and away the largest source of customers means that the economic model is very much intact. But I've considered in building that business the success of Agora Publishing over the years. The transformation of that business was Bill Bonner inventing something called the Daily Reckoning, where he published every day 6,500 words, very high quality words,
Mhm.
where he gave away observations, he gave away paradigm, he gave away technique for free.
Mhm.
And he built a community of 750,000 people who trusted him. And
Mhm.
because of that, he was able to give away paradigm, but he was able to sell branded conclusions. He could say, if you like my gold thesis, here's my gold letter. If you like my broad economy thesis, here's my ETF letter. And where my media business is going is the same way.
Mhm.
I want to build a community by giving away very valuable material.
Mhm.
And unlike Bill, creating a real community where my discussion groups allow people to teach each other, that kind of thing. And
Mhm.
ultimately, I want to sell branded conclusions. Ultimately, where I want to go is when I've taught people how to analyze companies, I
Mhm.
want to bring in companies to the classroom live. And I want to emulate the circumstance that occurs when those companies come to my own conference room and sell me stock. But rather than have them sell me stock in front of myself, have them sell me stock in front of 5,000 of my students. Allow the company to do a 15-minute page turn, a presentation because you have to. They don't know what to do without that. So allow them to get that off their chest first, and then interview them, perhaps with a small panel of experts for an hour, not hostily, but
Hmm.
also not as advertising, just the same way as I would interview them if they came into my boardroom trying to sell me stock. And then for an hour after that, uh, allow them to answer questions emanating from the classroom. That's where rural investment media is going.
Very cool. Curious though, what is the rubric for how you grade stock? Is I'm guessing is not A, B, C, and D, and is based off of how Rick feels today. Does
Well,
it? How much of it is? You know.
first of all, it's personal. And so I probably grade speculative stocks higher than I would grade them if I was grading them purely for other people. I don't discount my
Hmm.
rankings for the potential ignorance of the investor base. I
Hmm.
grade it from my own perspective. I'm
Okay.
also much more tolerant of political risk than most investors are. Uh, I've I've decided for myself that there are no good jurisdictions at all, anywhere, ever, that they're all bad, just varying degrees of badness. And so the idea, as an example, that the People's Republic of California, where I'm from, is materially less risky than
Hmm.
the Democratic Republic of Congo turns out to be statistically not true. It's a different kind of risk.
Yeah.
So my rankings would vary from popular opinion around political risk.
Hmm.
I care a lot about uh, financial stability. That is to say, since it's a cyclical business, the ability to
Hmm.
withstand a downturn
Hmm.
and the financial resources to take advantage of an upturn. So I'm more balance sheet and income statement focused than most folks are.
Yeah.
I'm also, because I'm quite skilled at it, pipeline focused. Because natural resource based businesses are by their nature ones where your sources of cash, your assets deplete,
Yeah.
to make sure that the company that you've invested in is an ongoing concern. In other words, that there are new reserves and resources that are in the pipeline that can replace the reserves and resources that you've produced, unless short-lived resources are priced at such an extraordinary discount to net asset value that you're comfortable as a
Hmm.
shareholder presiding over the liquidation of those. If you're buying, $15 in distributions over 5 years with $4, that's
Hmm.
okay. You don't need reserve life beyond 5 years. But most people don't have any criterion by which they adjust their investments at all.
Hmm.
Uh,
Yeah.
a one, which is my best grading, is extremely, extremely rare. A one ranking is a company that I think is selling at a 50% or greater discount to liquidation value, meaning that if they sold the assets on the street, paid off the liability, uh, that there's a double left in it in liquidation for shareholders. In other
Hmm.
words, it's a dollar bill available for $5. Very rare, but it gets much harder. I have to believe that what they are
Hmm.
worth is going to minimally double within 3 years. In other words, I'm talking about a 3 year four bagger. And I think there has to be a
Yeah.
possibility that what they're worth can grow tenfold in 5 years. Um, I've had, I think, 11 one rankings in 30 years of ranking stocks.
Wow.
Uh, so it's extremely rare. Uh,
You're
a 10,
talking 11 portfolios or 11 companies?
I've had 11 companies
Wow.
that ranked one in 35 years of ranking companies. And there have been some extraordinary bargains in there. There are always warts. Otherwise, that pricing wouldn't
Hmm.
exist as an example. Um, 6, 7 years
Yeah.
ago, I guess, Ivanhoe Mines, run by Robert Friedland, uh,
Hmm.
was on the scene, and copper was problematic, and Congo was problematic, and that story was about copper and Congo.
Mm-hmm.
But the math was compelling. First of all, I had the best mining financier of our epoch, high quality manager. It's like
Mm-hmm.
icing on the cake, right? But I had what I thought was the most profound copper discovery in the world for 20 or 30 years. Uh, I had it in a wrapper that, in addition to having the copper, had a platinum deposit in South America, pardon me, in South
Mm-hmm.
Africa, that the Japanese government had invested $200 million in for a 10% interest. So I had a redundant asset off the balance sheet that was arguably worth $1.8 billion. In Ivanhoe, I had a stock that was selling at 63 cents, where the
Mm-hmm.
Chinese government had just bought a position for $1.20, and where they had
Mm-hmm.
95 cents a share cash in the treasury. Uh,
Yeah.
Liquidation value greater than 50%? Absolutely. Absolutely. We were rewarded. That stock went from 63 cents to $15 in the course of 6 or 7 years. That was more than I expected, frankly,
Yeah.
but that's okay. That's the kind of surprise you like. But the point of it is they're very, very, very rare.
Yeah.
Twos are fairly rare. I have very few threes, and my threes are always in, not always, but almost always in either commodities or jurisdictions that the market hates or is at least afraid of. If we get further
Interesting.
deterioration in the oil price, as an example, um, it would surprise me if I didn't elevate Exxon to a three. Uh, Finest oil company in the world, selling at, I believe, a 40% discount to what it's worth now.
Mm-hmm.
Uh, the probability that what it's worth doubles within 2 or 3 years.
Yeah.
I don't need to go down the quality trail very far. In fact, I
Yeah.
can start at the top in a sector that's as out of favor as oil and gas. When outside investors look at the oil and gas, they say, well, the growth comes from Guyana. I can't spell Guyana. Well, it's not
Mm-hmm.
Exxon's fault. Learn to spell, you know? Uh,
Who cares?
yeah. And they don't like oil. It's bad for salamanders, or Greta Thunberg told them it's going out of style or something like that.
Yeah.
Uh, the reasons that people have for not doing the obvious are very strange to me.
I think I remember you and I were together with Andy, and I think we're talking about oil being out of favor, and people, if I remember correctly, they see oil shelf life for like 10 years, whereas maybe you see 30 or more. I mean, can you,
It's
I may be misquoting you, so if you can correct me
a little worse
and
than
if you
that.
can,
The consensus, according to the experts, Angela Merkel and Joe Biden, and
yeah,
those experts, is that peak oil demand occurs in 2030 or 2032, which is what, 5, 7 years from now.
yeah,
Peak oil demand doesn't occur in my lifetime, and I'm a healthy 72-year-old. It might not occur in your lifetime. What that means is that when
yeah,
people do net present value calculations on oil and gas companies' reserves, is that they leave out most of the reserve life.
yeah,
I mean, this is really, really, really simple stuff, but people don't do it. And I'll say this in public forums, and people will say, "But Rick, what about, like, electronic, like, EVs and alternative energies and stuff? I mean, where the world is going is all this stuff." So yeah, that is where the world's going, but not soon enough to make a difference. I
yeah,
read some startling statistics. The first statistic I read, which I quoted a lot, was that by we I mean humankind, has spent $5 trillion over 40 years on alternative energies, and we've reduced the market share of carbon-based fuels from a
yeah,
high 40 years ago of 83% all the way down to 81% today. There was a 2% drop for a $5 trillion investment. The International Energy Agency very recently was quoted as saying that the aggregate investments in alternative energies, including government investments, is $11 trillion. So if we spent $11 trillion publicly and privately on alternative energies, and we've reduced the market share of carbon-based fuels from 83 to 81%,
Right.
how much money will it take to reduce demand for fossil fuels or their market share to 60%?
Yeah.
And then, Steve, juxtapose that with this. It is estimated by many people that global demand for all forms of energy, motor fuels, electricity, everything else, doubles in the period 2025 to 2050. So if you were to reduce the market share of fossil fuels from 81% or 80% down to 60%, but the market doubled, what that means is that the aggregate demand for fossil fuels still grew.
Right.
Not the problem. The opportunity for me is that narrative matters more to most people than math. Math wins over time.
Yeah. So you go over this stuff in boot camp and Rule Classroom and teach people not only to grade their own portfolios, but to do the actual math and educate themselves. And it seems as though you also train them how to be able to be intelligent investors and be able to argue for why they're investing in a certain company. For people who are novice investors or think, okay, I want to invest in the natural resource sector, but don't know how, but they're just getting their feet wet. Do you have anything for them? What can they do? And if you can just
Absolutely.
tell us a little bit more about kind of what you provide.
Go to the Rule Classroom. There's 250 hours of instructional programming. Every week that I'm at home, there's a free question and answer session on Thursdays by me. Now, there's 3,000 questioners and there's one of me, so not every question gets answered, obviously, but it's free. You can learn a lot lurking there. But more importantly, at the Rule Classroom, there's a feature called Introduction to Natural Resource Investing. If my memory serves me well, there's 11 half-hour lectures there, and it's absolutely free. I teach you the basics of natural resource investing based on the lessons, many of them hard won, that I've learned over 50 years. And as I say, it's absolutely free. There are another probably 200 hours of instructional programming there for free. There is the Rick Rule YouTube channel, where there are probably 150 hours of company interviews and programs, all for free. So the total elapsed amount of free programming available in those two sources, although there are some dupes, is probably 400 hours. When any of your listeners get through all that, I'll give them some more sources.
Rick, how can people find you and learn more about your website and the services you provide?
Really two ways. Go to ruleinvestmentmedia.com if you're already a natural resource investor, and I'll rank your portfolio. If nothing else piques your interest, that will. That's absolutely free.
Wow.
Go to the website, the Rule Classroom. Hang out, participate. There's hundreds of hours of programming there, absolutely for free. If you find it worthwhile, consider becoming a paid subscriber to the Rule Classroom, or consider that every 90 days we do an 8-hour-long deep dive called a boot camp. It's only $100. We've done silver, we've done uranium, we've done gold, we've done industrial and rare materials. And by the way, that course, if for any reason you don't think you got your money's worth, just email me. I'll give you your money back. An absolute ironclad money back guarantee. These are all very, very, very high quality products. In addition, there's a monthly newsletter, the Rule Resource newsletter, done by myself and Paul Harris. available for the Rule classroom, hugely overpriced. It's free, absolutely free. So there's all of that stuff for free. If, as a consequence of giving you knowledge, giving you technique, giving you paradigm, you want me to do the work for you, you want to buy branded conclusions from me, that's coming, but it's not here yet.
Rick, I am not good at math, but I know that free is a good price.
It
And
is.
thank you for doing God's work, as people, as your fans say. It's a true honor to have you back, and for teaching me. And I'm hopeful and confident that people will take benefit from your resources that are a great price. Thanks everyone for tuning in. Steve Yang, Natural Resource Stocks. Always stay smart, curious, disciplined. Rick Rule, thanks again. A huge fan.
Always a pleasure. Thank you.